Good afternoon, and we will continue our discussion on the accounting issues, and today we will focus attention on one particular decision, that is stock buyback, stock repurchase or capital reduction. You might have seen in that 2010 several companies all over the world, India or US or any other European countries. You might have seen that many companies have actually started using or use their extra cash available on the balance sheet to buy back the shares or to do stock repurchase. But what is this stock repurchase? Why this stock repurchases is adopted or used, and how these stock purchases happen, and how this stock purchase affect the balance sheet are some of the issues which we will discuss today. Stock repurchase is a shares bought back by a company. It is a form of a capital reduction. In India it is called buyback of shares, and many times it results in a cancellation of share. In the impact of the balance sheet, let me make it very simple first, that whenever there is an issue of capital, cash goes up, capital goes up, premium goes up, and stock repurchase, cash goes down, capital reduces, and retained earnings or accumulated profits reduces. Let us take a simple balance sheet, an hypothetical one, to understand the impact of stock repurchase on the balance sheet without getting into the conditions attached to the stock repurchase. For example, in this case you have 50,000 capital and there is a huge reserves. For the time being, let me assume that entire reserve is accumulated profit or free reserves. I will explain the free reserves bit later on. And the company is also having huge cash on the balance sheet and is planning to buy 5% of the capital at the rate of 20. The face value of the share is 10. What will happen to the balance sheet after buyback? After buyback, you can see the capital is reduced by 5,000. So, I think here I would like to rectify 10% of the capital is bought back. Let me make a correction here. So, 10% of the capital is bought back. Sorry for that. And so, the capital is reduced by 5,000, the cash is reduced by 10,000, the reserves are coming down to the extent of the premium that you paid, and because of the conditions attached, you create a special reserve called capital redemption reserve. So, let me summarize. Before the buyback, there was a capital of 50,000, the capital reduces to 45,000. Before the buyback, there was a cash of 250,000 and the cash reduces to 240,000 as the excess money paid over the face value is shown as is reduced from the reserve, and as per the condition you create a capital redemption reserve to inform to the shareholder that there is a buyback happened. By seeing the balance sheet, you create CRR. But observe this balance sheet and compare this balance sheet with the previous balance sheet. In the previous balance sheet, there was cash. In this balance sheet, there is no cash. We want to understand, can this company go for a buyback? The answer is yes, because there are reserves sitting on the balance sheet. But if you do not have cash, then you can arrange the cash by bringing more loans, either by selling off your assets or selling off your shares at profit or at par, that is your decision. So, arrangement of cash is possible and that cash can be used to buy back the share. Suppose in this example, the company decides to borrow money to buy back the share. In that case, the new balance sheet will look like this. The reserve, the loan will increase, the capital will come down, no change with respect to the cash, you can see that, and as usual there is a CRR being created and the loan has increased by 10,000. That means, in this example, the buyback has been financed through a loan. But now see a different condition. There is cash, but there is no reserves, no free reserves. In the previous case, we saw that there is reserve, but no cash. Reserve, no cash. But here, there is no reserve, but cash. Can the company go for a buyback? Answer is no, because buyback is a conditional decision. Most of the countries, they say that unless there is a distributable profit, you cannot go for a buyback. Why? In order to protect the interest of the debt holder or outsider, this presence of reserves, that too free reserves or distributable profit, is a condition for a buyback. So that means presence of distributable profit is a condition for buyback, not the presence of cash as a condition for buyback of shares. So buyback, as I mentioned, is a conditional business decision, and these conditions depends on various country laws or specific to separate countries. But the broad categories of these conditions are presence of a distributable profit or free reserves. Most of the countries have this. There is a cap on the premium. For example, in Singapore, they say that the premium cannot exceed 10% to the market price. Cap on the capital. For example, in Singapore, you cannot buy capital buyback more than 10%. For example, in India, buyback cannot exceed 25% of capital or the reserve, whichever is lower. Similarly, there may be a condition on solvency. That means post buyback, you cannot have a high debt equity ratio on the balance sheet. In India, the condition is given as 2:1 post buyback. Similarly, there is an accounting condition. The accounting condition is, to the extent of the face value of the shares bought back, a reserve has to be created, and that is called capital redemption reserve. So distributable profit, cap on the premium, cap on the capital that you can bring back or buy back, the conditions of solvency and the creation of CRR are embedded or incorporated in the buyback conditions of various countries. The specific specs may be different. The word treasury stock is closely related to buyback. A company which buys back its own share, if it holds on instead of cancelling, then those shares are called treasury stock or treasury share. Let me show with an example. The same example which we have seen in the previous case. So the capital 50, after buyback 45,000, but if I do not cancel the capital, then I can show that treasury stock as a minus 5,000, and minus 5,000 is also called the treasury stock. So while computing the equity, if you see most of the companies which in US, the treasury stock is shown as a negative equity on the balance sheet. So to that extent, capital has to be reduced, but not yet cancelled. But in principle, both are same, only presentation is different. So that leads us to why do companies do buyback? I will pick up only one answer here, that is with respect to the earning per share. In principle, all other things remaining constant, the stock repurchase increases the earning per share. I will continue with the same example, put in another additional item, that is a profit after tax is 50,000. Before the buyback, 5,000 shares were there. After buyback, 4,500. So EPS before is 10 and EPS after is 11. So therefore, EPS goes up, all other things constant after the stock repurchase. To summarize, many times the increase in EPS is a motivation for buyback, or sometime it may be increase in the promoter stake, which we have not discussed now, or sometime it can be a protection against the hostile takeover, buyback as a mechanism, or they often say that buyback is a way to return to the shareholder. Dividend versus buyback is a very important issue which can be discussed. Where is this leading us to? We would like to understand some of our future classes. Is there an impact on a stock repurchase and and the market price of the share. Market price, market price. Thank you very much.